Hey, welcome everyone. Tom here from Park Avenue Trading, your chief dealer, going to give you a lesson on retracements, and in particular, Fibonacci retracements, because everybody seems to be interested in them. And this video is going to be a little bit geeky in respect to the fact that I'm going to give you a little bit of a history lesson, a brief one, on Fibonacci retracements. Now, if I asked you, and I want you to answer yourself in your room right now. I obviously can't really hear your answer. I would say to you, I would ask you the question, like, where did this idea of Fibonacci retracements come from? Why was an ancient mathematical formula all of a sudden really fully adopted into the marketplace for people to use as a means of a trading philosophy, or a trading system, or looking for support and resistance? Where did this come from? And that was the first question after I learned it back in the late 1980s, that when I was first introduced to the retracement levels, I was like, why are we using 382? Why are we using 0.618? Why are we using 0.786, which I changed to 0.82? I want you to do that in your tool, but that we're getting ahead of ourselves here. And where did this stuff all come from? Well, the first incarnation of this, was that, and I've said this before, and I'll say it over and over again ad nauseum, is that price advances and declines do not continue uninterrupted. Contra-trend rallies and trend reversals occur all the time in the marketplace. And, as a trader, our job is to predict the extent and duration of these moves, so techniques to try to figure out these points in the marketplace were, prevalent continuously. I mean, if you look at this marketplace as it is right now, I mean, how many times have you could look at a dead market and go, oh my goodness, if I only got short up here, and I knew if it broke this bottom it's going down, and then, oh, look at this, there's a reversal here, a little bit of reversal, if I got short up in here, or you would say, you would discount that, going, well, I'm short up here and I just leave it alone, and the marketplace continues down. That's a game that we all play with each other in a dead market, because apophenia is at play here, which means that the mind is always looking for patterns and pattern recognition, and it's real easy to see after the fact. It's difficult to see as the market is evolving. So you got to understand, when you're doing testing for your system and stuff, you got to act. With TradingView, you could actually erase the future and actually trade as if it was occurring, which I think is a great thing for people that want to develop trading techniques, but I digress. Generally, little preparation and forethought is given to selection of points and legs and things like that. They just, people just haphazardly throw these things up on the chart. Now, the ratios, where did they come from? Well, there was a gentleman back in the 1930s, and his name was R.N. Elliott. And he wrote an article for Financial World magazine in the 1930s. And he started studying market, 75 years, I believe, of the stock market. He went back and he studied, and he came to the conclusion that markets aren't really haphazard in their movements. They actually follow a mathematical formula, and he introduced the Fibonacci formula to the world, the 0.382, the 0.618. Now, what made him actually look at those points? Well, there was in the past, excuse me while I light my cigar, there was in the past, and I'll keep it away from the mic because I know it sounds like a jet engine going off. There was in the past a theory that many traders use, that market retracements or advancers from a market retracing from a high, if it's still truly in an upward movement, would go down 3/8 to 5/8. Now we're talking, because they're trading stocks, they use 3/8, a half, 3/8, 5/8. Now they said that a common occurrence in retracements was 3/8, which if you do the division, it's 0.375 to 5/8, which is 0.625. Very, very close to 0.382 and 0.618. So he decided that he was going to do some studying, and what he found was that the Fibonacci sequence really applied really well to his new theory of wave analysis. Now, he wrote a book later on, before he died in like the 1940s. He wrote a book called that. Oh my gosh, it's slipping me right now. The secret of natural law, I believe, or natural law, nature's law. That's what it was, nature's law. And he wrote that, and he published it in June of, I think, of like 1946. I think it was like a couple of years before he kicked the bucket. So anyway, that book and his theories, because everybody's looking for the Holy Grail, actually propelled Fibonacci into the marketplace. Now, he developed Elliott wave theory off of it. Now, Fibonacci's riddled with, Elliott wave is riddled with Fibonacci theory, but I don't want to get too deep into that, because that's a completely, we could talk about Elliott wave theory forever. I've found like some principles of Elliott wave are good. If you're looking at market structure, they're good. I have never really been able to put together any type of relevant trading system with Elliott wave itself. I'm a firm believer, if the market's going up, look for a place to buy it. If the market's going down, look for a place to sell it. Because I'm a day trader, I'm not looking for what it's going to be 3 years from now. I really don't care, because there's going to be so much opportunity day to day. So with this video, we're going to talk about the points themselves. And we'll write down the ratios just in case you don't have your number 2 pencil around, that you can write them down. But I'll write them down. Then we'll talk about how you actually do this with a handheld calculator. Because when I first started, there was no Fibonacci retracement tool, none. We're talking back in the 90s. This stuff didn't have it. But you really should understand how to do it by hand anyway. Because let's say, for instance, you're not at your chart, and you're somewhere at a restaurant, and a market alert goes off or something, and you want to calculate a retracement level. Well, you should be able to do it, because you should be able to remember your low that you're working off of, and like the recent high of the marketplace and the previous high of the marketplace. We're going to discuss some things in this video that are kind of maybe new. I'm sure will be new to a lot of people. So let me write that out and put it out on this chart here. Okay, so the mathematical foundations, the Fibonacci sequence, discovered by Leonardo Fibonacci, was basically a sequence where each number is the sum of the 2 preceding ones. It's found in various natural phenomena. There's been many books written about it. The pyramids of Egypt, the migration of geese, pine cones, you name it. They'll find the Mona Lisa. You're finding all of this. This 0.618, which is, they deem as the spiritual number of the universe or something. I don't go so far as that. But, with trading with Fibonacci, basically for me, is I think it's a self-fulfilling prophecy for the big traders that are using it. So it's important to know what tools they're using so we could participate in what we think they're attempting to do. We don't have access to the order book, but we could see what the marketplace is doing and how it's reacting at these levels in order for us to get a key and sub. So basically what we're saying is, we start off with 0. I should put a comma over here. 0, 1, 1, 2, 3. So when we add 1 plus 1, we get 2. When we add 2 plus 1, we get 3. When we add 3 plus 2, we get 5. When we add 5 plus 3, we get 8. When we get 8 plus 5, we get 13. When we get 13 plus 8, we get 21. 21 plus 13, 34. 34 plus 21, 55. And so on and so on. It goes into infinity. Now, after you get past a certain duration of these numbers, I believe it would be, 8 iterations of doing this. When you divide the numbers, you're going to come up with the ratios, the proportions. So we're going to find out that we got 0.382, 0.618. 0.82 is the number that I'm basically changing the 0.786 to. And an intro that I'm going to be introducing you to is that what traders generally make a mistake with Fibonacci is they if it breaks the 0.82 or the old 0.786, it's going to the low. That's not necessarily true. And I'm going to ask you to study the low days or the low bars close, or the high. If we're going up and we're breaking levels upward, it's not really the high you should be targeting. It's the close of the high bar. That's more important than the high itself. Many traders miss good trading opportunities when they're trying to wait for the high to come in again. Now, sometimes it does surpass it. There's nothing perfect in trading, but many times it doesn't. So I'm going to ask you to go back as one of your action steps today is like, after you learn how to do this, I'm going to ask you to go and run like, okay, it broke 0.82, which I'm telling you is better than 0.786 for skid. Just like if we look at the 3/8 and 5/8, okay, they're a little bit bigger than the 0.382 and the 0.618, slightly, not much, but really you could even use those levels. Those were old school levels. Okay, but I'm not saying to change everything. I'm just saying, just keep that in mind that the old school traders basically would use 3/8 and 5/8. But Elliott made it really popular to use Fibonacci, a Fibonacci scale. And the thing with Fibonacci is you don't really need to wait. You don't need a high to come in to use it. With the old timers, they needed a high. A high is coming in, the previous high was X, so we could get a retracement 3/8, 5/8 down from there for a good buy level or a good level to reaccumulate stocks again. With Fibonacci, you don't need to do that because you can measure individual legs. And we're going to get into that in the course itself. We're going to introduce you to, the coffin box, which I put a video out on YouTube about, where markets generally stop at 0.618 and 0.82 on a retrace. There's also a coffin box on the bottom, and I'll go over that in a future video. But so what do we do with these numbers? So let me move this over, get them out of the way. So if we're going to use these Fibonacci retracement levels, okay, all we're going to be doing is we're going to be measuring a leg on this video. We're not going to do the whole method of going back in the past and looking for we're just going to be measuring legs. Simple, right? Well, we had this leg that came down right here. Now you can say, all right, I want to apply the Fibonacci retracement levels to just this leg itself. Okay. Is it really proper to do it that way? Yes, because we're doing short-term trading and we're just looking for levels to get involved, levels to find resistance and support. Market has moved down. It's been kind of in a downward movement. Okay, so if we're trying to look for a place to get long and for it to basically shoot up and turn and reverse, which is not always the best way to trade. You should be going with what the trend is. But just for this example, not getting into philosophies of trading or whatever, we're just going to use this. So if I said that this high right here is 176 the figure, and I'm going to put it in the old calculator, 176.0, and I'm going to look down to this new low that I have right here, okay, is, get over there, 173.80, 173.38. This is a 4-hour chart on Swiss yen. So 1.173.38 out. We have a movement of 262 points. That's just the high minus the low of this leg. All I'm going to do is I'm going to take that 262 points and I'm going to multiply by 0.382. Multiply by 0.382. And I come up with 100 points. So from the low of 173.38, I should have resistance at 174.38. I'm just going to put it up on here. 174, close enough. 174.38. Market comes up, it touches it, bangs off. It does not retrace at that point and go down. Okay, the market continues. So now I'm going to take that 262, multiply by 0.618. I'm going to get 162 points. So 173.38 in, 1.62 in. Market should find resistance at 175 even. That's a nice retracement back down. Not exact. Probably would have been better off using 5/8 instead of the 0.618, but okay, hindsight's 20/20. But I want you to notice the two things here. If you, for whatever reason, sold this level, saying I'm selling the 618 because that's like, I like selling 618s off of that leg. When you broke 0.382, you were looking for the low to either get back at, or hopefully it breaks and it goes lower and you're in the train, and that's great. But I want you to notice, this is a 4-hour chart, and we say we're trading 4-hour charts. I want you to notice the close of the bar before the reversal up. Now, I usually say the low bars close. Obviously, it's not the low bar because the 4 hours after it went a little bit lower before it ran stops, and then the marketplace moved up from there. But if I mark this, if I just put my cursor right here, actually, let me put a line there. What the heck, so I can show you. That's not a good color, sorry. The marketplace came down. If you're targeting the close, you're out. And you made money, right? If you weren't, okay, you may be chasing the market back up 4 hours later and getting out at, let's say, 174.35. Now, you could have got out at 173.63. That's a significant amount of money being put in your pocket. So the close of the low bar or near the low bar, okay, because you have that reversal, you can't really say that this bar is it did go lower. So here we go with the gray area of trading. I would go to this bar right here, because that is the lowest close I got in the series, that bar right there. Marketplace goes up. Okay, so let's say, for instance, since we're making money, why not continue to make money, right? It always feels good to make money. Let's say you got in at the close here. You got long with a stop loss down here. What an excellent trade. Okay, so now what are you waiting for? You're waiting for the break of the 0.382, which you get on this 4 hour. It doesn't do much, but it breaks it. Oh, but did it close above it? No. Next bar is the queen that I talk about. This is actually the king. Sorry, this bar closed above the 0.382, closed above the 618. The next 4 hours does not reverse. It stays above. The queen is saying yes. We're going to go a little bit higher. How much higher? Nobody knows. Nobody knows. However, let's use good old Tom's theory that the close of the high bar is an important target point. And I'm just going to take this line and I'm going to move it to the close of the high bar. Marketplace spikes it. Oh, okay. Out. If you got out, you got out. You got down, you got long here, 173, 63. Market comes up to 175.90. What a trade, man. And, good daily trade. Great. You escape at the close of the high bar. Now, you're not looking for 1.382. Remember, the ratios are 0.382, 0.618. The high or the low, that. But if you didn't have that little trick, you'd be looking for 1.382 extension. Now, do markets do that? Yes, absolutely. How many times did it do that? That's the question I'm going to ask you to do. I'm going to ask you to go back, take this little video, go back and try this stuff. Okay, that's your homework. How many times does the market only go to the close of the low bar on whatever time frame you're looking at? How many times does, when it breaks and it's moving up, does it go to the close of the high? Now, there's a system in here somewhere. Like I knew guys that basically, they didn't even do the Fibonacci stuff. They just basically went, looked at markets and said, oh, you know what, I'm going to buy this close, put a stop at what that low was. And I'm going to target the high bar's close. You could do that. You could test it. Okay. I like getting more involved with my hand, trying to really figure out the internal workings. But anyway, I hope that you enjoy this video on Fibonacci. And I look forward to seeing you in the next video. And we're going to continue with the course. And this gives you the way to do it by hand. So instead of having this tool basically doing this for you, okay, you could do it all by yourself. And you notice that the tool lines up. Now, that's actually backwards. That's why I hate these tools. I really do hate them because I never know which way to go with this thing. Like if I want retrace, here we go. I guess that's the way we got to go, right? Yeah. So here was the 0.382, the 0.618. At the 50, I don't really use. That's not a Fibonacci number. But, I should actually take it out of this tool. I don't use tool. I use everything by hand. So again, I look forward to seeing you in the next video. And remember always, when you're targeting markets, enjoy the party, but dance near the door. Cheers.